Let's dive into the story of J.Jill Inc., a retail survivor in a brutal market. J.Jill targets women over 40, offering comfortable, stylish apparel for those who want to look good and feel good. Their focus on this loyal demographic has been their strength, but retail is a battlefield. Fast fashion, e-commerce giants, and changing tastes are relentless. J.Jill operates both physical stores and a strong online presence, what's called an omni-channel strategy. This isn't just a clothing store, it's a business fighting to stay relevant. Why talk about J.Jill now? Because the company is at a crossroads: new leadership, tech upgrades, and a stock that's seen wild swings. For investors, J.Jill is a case study in brand loyalty, the dangers of debt, and the need to adapt. It's a lesson in risk, patience, and potential reward. Before investing, you need to do your homework. That's what we're here for. We'll break down its past, present, and possible future. Is J.Jill a hidden gem or a value trap? Let's find out. Time to dig in. Booyah! Picture this. 2017, J.Jill goes public at $63.25 per share. Hopes were high, but reality hit hard. The stock slid, not soared. Today, June 2025, it trades around $16, a 75% drop. While the S&P 500 climbed 80%, J.Jill went the other way. Early investors? Ouch. This underperformance is a red flag. Something went wrong. Whether strategy, execution, or just the tough retail environment, the ride wasn't all downhill. There were brief rallies, but volatility rules. The stock hit a 52-week high over $40, then crashed to $14. Bulls see loyal customers and strong margins. Bears see declining sales and heavy debt. It's a tug of war, and right now the bears are winning. A stock that's lost this much is what we call a falling knife. Catching it is risky. J.Jill did start a dividend in 2024, offering a small income stream. But don't be fooled. A dividend can't fix a collapsing stock price. J.Jill's stock history is a cautionary tale. Beware the hype, and always look deeper. The lesson? Caution first. Let's keep digging. Every company has strengths and weaknesses. For J.Jill, the biggest strength is its loyal, focused customer base. Mature women who value comfort and quality. This loyalty means repeat business and less need to chase every trend. Another plus: profit margins. J.Jill consistently posts gross margins above 70%, a sign of pricing power and disciplined management. But there are big weaknesses. Debt is the elephant in the room, over $200 million as of 2024, with a high debt-to-equity ratio. Debt limits flexibility and eats into profits. Growth is another issue. Sales are shrinking, down nearly 5% in Q1 2025. Wall Street expects slow growth, far below industry averages. Loyal customers are great, but without new ones or more sales, the business stagnates. High debt, slow growth, and fierce competition make J.Jill a risky bet. The company runs a tight ship, but the waters are rough. For investors, these risks can't be ignored. The bottom line strengths are real, but so are the dangers. Know both before you invest. Let's see how J.Jill stacks up against the competition. Onward. No retailer stands alone. J.Jill's main rival, Chico's FAS, both target the same loyal, affluent, 40-plus female customer. Chico's is aggressive with loyalty programs and promotions driving repeat business. J.Jill relies more on brand image and product quality. It's a battle-disciplined operator versus savvy marketer. Then there's Nordstrom, a retail giant with scale, brand recognition, and legendary service. Nordstrom offers breadth. J.Jill offers depth in its niche. J.Jill is a boutique. Nordstrom is a superstore. This means J.Jill is squeezed, direct competitors on one side, giants on the other. To win, J.Jill must be the best at serving its core customer with unique, high-quality products. They can't win on price or selection, only on niche appeal and brand identity. The competition is fierce and the margin for error is slim. J.Jill's only path to victory? Double down on what makes them special. Anything less, and they risk getting lost in the crowd. The stakes are high. Next, let's look at the numbers. How healthy is J.Jill really? Let's find out. Time to check the numbers. In Q1 2025, J.Jill brought in $153.60 million, a 4.9% drop from last year. Declining sales are a warning sign. Gross margin? Still strong at 71.8%, showing efficiency and pricing power, but net income fell to $11.7 million from $16.7 million. Profitable but shrinking. Debt remains a concern. $74 million in funded debt, improved but still significant. Debt means less cash for growth or shareholder returns. Free cash flow also dropped, a red flag for flexibility. The numbers show a company that's efficient but struggling to grow. Profitable, yes, but fragile. For investors, the trend in sales and cash flow is concerning. J.Jill needs a clear path to growth to inspire confidence. Until then, caution is warranted. Let's see what they're doing to turn things around. In retail, adapt or die. J.JİLL is investing in technology to stay relevant. In March 2025, they launched a new order management system, crucial for smooth e-commerce. The rollout caused a temporary $2 million sales hit, but it's now stable and should boost efficiency. They're piloting ship from store, speeding up delivery and improving inventory management. These tech moves are smart bets for the future. J.JİLL also has a profitable accessories segment, scarves, jewelry, handbags, about 10% of sales. It's a simple way to boost revenue per customer. Store strategy, careful, not reckless. Opening just a few new stores, closing underperformers. This cautious approach makes sense in an uncertain economy. Management is focused on long-term health, not quick wins. Tech upgrades, side businesses, and strategic store moves show a team thinking ahead. They're planting seeds for future growth. Will it be enough? Time will tell. Next, let's look at J.JİLL's possible future. Where could this company go? Where is J.JİLL headed? By 2030, success depends on stabilizing sales and paying down debt. If tech investments and new strategies work, the brand could regain strength. By 2040, the challenge is bigger. Can J.JİLL attract the next generation as its core customers age? Success means evolving style and marketing without losing loyal fans. Failure means fading away. By 2050, J.JİLL as an independent brand would be a huge achievement. More likely it's acquired or becomes a niche online brand. The biggest risks: recession, new competitors, and failure to adapt. The path ahead is full of obstacles. Survival means constant reinvention. The odds are long but not impossible. For investors, the future is uncertain and risky. Only the most adaptable brands survive decades. J.JİLL's journey will be a test of resilience. Let's wrap up with the big question. Could this stock ever go to the moon? Could J.JİLL at $16 ever hit $1,000? Realistically, no. That would require over 6,000% growth, reserved for tech giants, not mature retailers. Even with 10% annual growth, the stock would only reach about $173 by 2050. A more likely scenario, modest returns if the company stabilizes, maybe 5% a year with dividends. Your $10,000 investment could grow to $34,000 in 25 years, not life-changing but solid. But if sales keep falling and debt rises, losses are likely. The bull case: loyal customers, strong margins, smart tech bets. The bear case: declining sales, high debt, fierce competition, and uncertainty. For conservative investors, the risks outweigh the rewards. For risk takers, it's a speculative turnaround play. Don't buy dreaming of $1,000. Buy only if you believe in a slow, uncertain recovery. That's the real story. Booyah.